Good morning and welcome to CTP's annual results presentation for 2021. Happy to introduce Remon Vos, CEO, Richard Wilkinson, CFO, and Barbora Knoflach, the chair. We will have a presentation of about 30 minutes and a Q&A session of about 30 minutes following that. And I would like to give the floor to Barbora.
Good morning. When we started to prepare for today's presentation, the world was different. The plan was to present to you record financials, to explain about what we did last year, and not last but not least, celebrate a little bit the very successful first year of listing within CTP. But since 2 weeks, the world has changed. Now we have to answer different questions. Now we have to ask ourselves, how will that impact this cruel Ukrainian situation? How will that impact all of us and CTP in special? We all do not have a crystal ball, and we also cannot look into Putin's head. Maybe that's not a bad thing at all. If this war goes beyond the Ukrainian border, I think we all agree we will live in a different world. Under the working assumption that this stays within the Ukrainian border, the activities and results of CTP of last year, I think, are of a nature that not many companies could have done in a parallel way. The growth you will hear and the strengthening of the organization and the upgrading of the structure are great achievements to make any company resilient. The passion, the speed, the clear focus on quality and on outperformance I had the pleasure to experience within CTP since Remon invited me to chair the board are really outstanding. And I think that these attributes are more than helpful for situations like this. The business model, develop, to own and to operate on the long term, is unique and very special in this environment. The balance sheet, as a result of last year's activity, is very strong. And I think we all agree liquidity is key. With these ingredients from last year's result and what I have seen, I am sleeping currently very well, even in this environment. The outlook here for what might be ahead of us, and despite of the situation we are in currently, I think that you will enjoy Remon's and Richard's presentation now, providing you with the insights of a very strong company, even in such a situation, and delivering in such a situation at least the clear potential for continued growth. Thank you. With that, Remon, the floor is yours.
Good. Thank you very much. And good morning, everybody. Thanks for joining. This is us. Richard will speak later. And a short update on where we stand. I'm going to talk to you about last year's results, all of the activities we've done, and then, of course, we're open to questions later at the end of the session. The war does not have an immediate impact in terms of CTP does not own any assets in neither Ukraine or Russia. We don't have clients who are affected massively at this moment by what's going on in Ukraine. So it is relatively okay. It doesn't have immediate impact to our portfolio, the income-producing part of the business. I'll get to that later. What we do try to support in different ways. We do financially support the UNHCR, but also operationally we offer accommodation to refugees. We have offered warehouse space to different NGOs, organizations who look after the people who unfortunately had to leave and are leaving the region. So that's what we do in order to support. Business-wise, any change is opportunity. We are a very entrepreneurial, dynamic business. We are very alert in all of the changes, whether that was 2008, 2009, or other COVID circumstances, which none of us had actually planned. It was in none of our business plans, but we had it in mind that something could happen. And then it's also an opportunity to react quick and to, sound strange, benefit from that. Especially if you have money in the pocket and if you are on the ground and if you have that entrepreneurial approach which CTP have. That's our culture. Obviously, these kind of situations, if I talk to my tenants, inventory, storage, extra, because there is a threat that some supplies may stop, change, and then it's better to have an extra little bit of stock. That's what we see immediately, so therefore the warehouse space. Also, we see different industries in the future grow. Defense is one, and others which mid-long term could be not necessarily bad. There's opportunities. Also, our business model, Barbora mentioned it, develop to own. We do not rely on any exit compared to some of our competitors who have a develop to trade model whereby they need to exit upon completion. And that may be a bit challenging these days, which could potentially create opportunities for us in countries like Poland. And is also a great opportunity to buy CTP shares for very cheap. We have done our best last year, as we have been doing for the past 20 years. We had ideas pre-IPO. We said, okay, guys, if everything goes well, this is what we can do. And we have done our stinking best to achieve some of that. It's in the booklet, and I'm sure you had a look at it. We can answer questions later on. In short, ahead of schedule and a bit better than what we had in mind. Compliment to all of the boys and girls at CTP, almost 500, especially when it comes to the yield on cost, which is 11.3. This is almost double of what our peers do sometimes. 11.3% yield on cost in a market whereby we have seen significant cost price increase, construction costs. So it takes a lot to make sure that you keep it within the budget. So well done to the procurement and to the people at CTP who do the construction. We've been able to grow and on schedule to hit the 10 million square meter, 12 months ahead. Occupancy okay. And we'll flip to that later and show you a few other slides as well, targets ESG related. I mentioned the headcount, currently at 520. Look at CTP, and I talked to someone the other day, and he said CTP is not one big company. CTP is 10 smaller companies, plus one other company. So, and that's how we also work. So we have these country teams, and they work independently from each other, which that's how we build them, and that's how they work. So that's the culture, that the country teams look after their business locally. And so very much a local business, and with knowledge of what's going on. And that seemed to work. It's a bit different than maybe other companies in the way they're set up, but that is good. In addition to the country teams, we have CTP International. International is just a group of people who support the countries. IT, controlling, all those kind of. And then we have been able to attract fantastic people, very talented. So in all of that, you can see in the results. 50-50, so 50 male, 50 female %, and average like 38 years of age. That's where we are. So fantastic to have all these people on board, and look forward to growing the team going forward. We have also been able to grow market share, and we're active in 10 countries. So last year we may have surprised you here and there. We entered Holland and Germany, everything in line with the the pre-IPO, the business plan, but we also did it. 10 countries. We don't think of 11th and 12th and 13th. We like to focus on those 10 countries, 10 markets, and see that we can double the size of the portfolio over the next 5 years. It's ambition. We're doing a strategic paper for 2026. More about it later, maybe. This is a summary of the portfolio as where it stands at the moment. You know all of that. The client base is quite nice. I'll have another slide on that. Here, with a breakdown of different clients. You know that our clients are the drive behind the growth. So 80%, 80 of all the new business we do with existing clients. So you have a tenant who's actually renting space in different locations. Logistics companies, e-commerce related, manufacturing. And we've seen, of course, nearshoring, all of those trends we spoke about. And that is really for 2021. You can see that in the results. Mostly, again, with existing clients. Buildings to last. In parks, clusters, super important. No standalone, but business parks where companies together can grow and support each other. Our park maker concept. And look at the portfolio. We divided in four, or in different, you could say 4 core markets where we are market leaders and continue to gain market share. Czech Republic, where we started. Slovakia, Romania, and Hungary. Those are the 4 markets, core markets, if you like. And then we have a few markets where we started, where we've recently been active. Serbia, of course, but also Bulgaria and Poland. And then Western European markets, Holland, Germany, and Austria, where we are constructing property in and out of Vienna at the moment, the capital of Austria. We're also constructing property in Amsterdam, and we've just completed a project in Rotterdam. With the acquisition of DIR, earlier last year, or this year, actually, I should say, beginning of Q1. With DIR, we also have been able to buy land, and we can build at least 200,000 square meters on the land, which came with the DIR portfolio. So there's very nice opportunities there. Yeah, and you can see that here. 900,000 square meter of new property, with also acquisitions which we have been able to do, especially to enter new markets, to get us going in the new markets. Similar to what we have done previously when we entered Romania. You remember we bought Prologis to get started. It's also the same tactic or the strategy we use for other markets where we are new. We buy some projects or income-producing stuff to get going, and before we buy land, and then do the whole cycle from land acquisition, design, permitting, construction, etc. Where, of course, you can gain more value there. The more you do, the more value you create. But to get going, you start with a mix of these different things. Yeah, a few highlights maybe. I know done a big one in Budapest. Of course, in and around the capital of Budapest, where we have 4 parks at the moment, but also Bor is one of our top 10 parks with more than 500,000 square meters on the German border for e-commerce business. Actually, 2 of them in here with a total of 130,000 square meters. Good. We see that large requirements of 50, 100,000 square meter, local, let's say, regional distribution centers, fulfillment centers for e-commerce related business. Can be fashion retailers. This is pet food. Dogs also need to eat, but on top of that, also 50% is light industrial manufacturing, nearshoring. So, yeah. And I didn't talk about that, but with the Ukrainians coming to Poland, that will also, I know it's bad, but if they find a place to live in peace, then they can also contribute to the GDP growth, of course, in Poland, places like that. There's plenty of job opportunities in that part of the world, definitely. And no Putins yet. I'll leave it to... it's a breakdown of where we are. I spoke about the 4 core markets. Maybe later with Richard have a closer look, if you like. Same with land banking. We're not shy on buying land. We've always done that. We like to buy land. We buy land for below 50 euro per square meter, which we think is cheap. And most of the land we buy in and where we have business already. So you extend your business parks or close by. So places where we are at home, where we have an organization, where we have tenants, where we know how the business works. That's where we put our money so that we have land for future developments. And the cycle of buying land, getting a permit, and getting a building completed is here and there takes more time, is more challenging. It's a very fashionable business, yeah. Other people like to be a part of this, so it's important for us to be ahead of that. Invest in land, get land ready in parks so that we can build buildings, which we actually do on speculative basis. At least we start with building buildings on speculative basis. And being our in-house general contractor is one of the reasons why we hit north of 10% yield on cost. Having a building under construction gives me a very good position to grab a requirement if the requirement comes to the market, and I have a building on the way. I can catch that business. That's one of the things. If you look at all of the land we own, 17.8 square meter of land, which is 12 million square meter ownership, and 5.8 is under option. You don't want to buy land without permits. So you have an option, wait for the permit, then buy. You could probably build 8 million square meter, a bit more. So if you hit 11 million square meter now this year, then you could think of even growing to 20 or beyond million square meter of lettable. If that's what we see. Yeah, again, mostly with existing clients with whom we work already. Their business grow, we build them more buildings. A few highlights. I mentioned Amsterdam. This is a project we are doing. I've been on Sunday. Check it out. Nothing to do anyway on Sunday. Brought my wife and had a look around. It's big, 120,000 square meter. We had some pre-leases and we continue to lease. Unique location in the city, very close to the city center of Amsterdam. We have easy access with electric vehicles or with over water, and no other supply coming to the market in Amsterdam in this part of the city. So we think the window is nice, and we are talking to a few users as well as to the city to see how we can make this a strategic part of logistics distribution into the city. Think of e-commerce, think of construction companies who need access to the city center. Then this is quite a unique project. But anyway, this is something which will help us to get started in Holland. We've bought land in and around Rotterdam, completing a project at the moment in Rotterdam, but also bought a project in North Holland at the moment, in a place called Alkmaar, and something close to Schiphol, the airport. Yeah, Germany, I mentioned it, 200,000 square meter of new build opportunity. Currently in the phase of doing design and permitting, and we're going to start in Bremen with a 28,000 square meter development in Q2. Building a team. And for myself, honestly, also this is where I focus on Germany and Poland. Those are the growth markets, and that's where I spend quite a lot of time building these businesses, where Richard looks after the established markets. Yeah, ESG related. We continue to grow forest and have a new head of ESG actually coming in. He started, Adam. Thank you, Alex. He is on board, former Skanska. To continue extend that department. But also I see other opportunity. ESG is important, but also other things which maybe not core immediately. The energy business within our parks. We have a lot of consumers, energy, of course, for our tenants. And we have now business models which we develop to create energy within the park, where we have the infrastructure. So there is another business line where we can make create additional income. Yeah, I leave it to Richard, I think. Richard, is that okay? Thank you very much.
Thank you. Thank you. Pleasure to talk to you today. Remon talked about the strength of the business, the strength of the business model, our ability to generate organic growth from our tenant base in our own land bank, in our parks. 86% of our land bank is in or around our existing parks or for new parks. 80% of our new business is with our existing tenants. So our growth comes primarily, the development growth is driven by our existing tenants. We have examples where tenants are in their 6th expansion with us in one park, and the only reason you can do that is because you have the scale and ability to offer something to your tenants that no one else is in a position to match. And what that means is we grow, we also get really nice financial results. I really like this slide because there's not a number I don't like on the page. I think they're all really nice. Whether you look at the growth in rental income, 16.5% last year, and we know that in 2022, our rental growth is going to increase significantly. Our rent roll at the end of last year was 437 million euros. So this year we will have a significantly higher rental income than we had last year. We had a substantial revaluation of our property upwards last year. I'll go into that in a little bit more detail, break down how that's put together. More than half of that comes from our development activity. So it's not just yield compression that's driving that result. Overall, we made, after tax, a little bit more than 1 billion euros. When I suggested to Remon that was going to be where we ended, he looked at me as though I was, that's nice, yeah. And then finally, despite the fact that we have 14% more shares in 2021 than we had in 2020, we increased our earnings per share by over 11%. We grew our property portfolio to a value of over 7.5 billion euros, and that's maybe my favorite number on there. Our ability to grow the portfolio and generate value, you really see there. And we will continue to grow. You see that investment properties under development. We have over 900,000 square meters, or we had at the end of 2021. We have 950,000 under construction now. We're a growth company. Our net tangible assets are 12 euros, a little bit more than 12 euros per share. The stock traded yesterday about 10% above that. I think it's a good deal. I put in a buy order with my broker this morning. Yield on cost, we continue to keep our yield on cost. Despite price increases, that also reflects the fact that we do see rental growth. And we start to see rental growth in all of our markets, particularly in the markets with tight supply. Czech Republic rental growth is going up significantly. If you look at the broker reports, and they're right, Prague is in the top 5 in Europe for rent increases. And that is what you see. We see it. We achieve it. And we look forward to hopefully starting our new development just outside Prague. It's the only big one that's around at the moment. Will be nice for us. If I go to the next slide, where did we generate these numbers? In our core markets, where we grew our market share from below 24% at the start of last year to 27.5% at the end of last year. So we're the number one, but we're still able to gain market share. You see 96% of our rental income, 98% of our profit generated in our core markets. That's also where most of our land bank is. So it's where most of our growth will continue to come. That we will, over time, diversify into other markets, but the driver for now and for the next couple of years will continue to be our high yield on cost core markets. Promised you a breakdown of our valuation gain. If you look at the 3 blocks on the right, or the left-hand side, the first 3, like-for-like rental growth, so valuation gain driven by that. valuation gain from our delivered development properties, and value growth in our land bank. You add those together, you come up just under 600 million, so over half of our valuation gain is from our core business, build to own and operate. We got some yield compression last year. I think there was not a logistics company in the world that didn't see yield compression last year. But if you look, the yield spread between Central Europe and Western Europe is still over 260 basis points, so there is still a massive differential between the property that we own in terms of its valuation metrics and the property in Western Europe. If I look at our capital structure, Remon and Barbora mentioned it, we were very front-footed in turning our bank funded model into a bond funded model. We pre-funded most of 2022 in September. Last year, we funded basically the rest of 2022 in the first 2 weeks of January. We locked in the attractive pricing that was available then. And we will, sit on, or we do sit on a very nice liquidity position that allows us to take advantage of opportunities as they come along. And you can see we have no significant debt repayments this year. The next material one is in November 2023. So our average cost of debt after our last bond in January is now down 1.11%, and a 6-year average maturity after that. When we were presenting the IPO to investors, we said we think there are 6 value drivers that are going to deliver mid-double-digit annual total return profiles. Now, the investment banker said to me that everyone's going to think that means somewhere around 16 to 20%. Good news is we delivered 47% last year. And the even better news is if you look at where we are at the end of 2021, basically almost all of these are either still in place or we already realized them and can start generating the growth from them. So we still have 6.4% gross valuation yield at the end of last year. We will still have like-for-like rental growth. We continue to change our leases from fixed escalators to minimum escalators, so minimum of 1.5% or inflation. We have 900,000 square meters under construction end of last year, 950,000 still under construction. We increased our land bank last year. We took advantage of the opportunities that were there. So we continue to have the profit driver from our development business. We did reduce our cost of debt. We did see some yield compression, but there's still a lot of potential there. And by entering Holland, by entering Germany, by strengthening our vertically integrated team, we create the platform to allow us to continue to grow. So we think we will continue to say, we can deliver highly competitive mid-double-digit returns. I don't think we can necessarily do what we did last year, but I think we can be deliver a nice return to our investors. And if we look at the outlook, and there's a big proviso here. Yeah, so we are assuming that the war in the Ukraine, which I personally deplore, does not spill over. If it does, then then none of this will. We don't know what will hold from that. But assuming that it stays within the borders of the Ukraine, then we expect the systemic positive demand drivers that have been in place for a number of years to continue to be in place. Some of them will actually be enhanced. Remon mentioned earlier, more people storing more parts of their production value chain. That is just going to happen. People will build resilient value chains, not efficient value chains, because it's too expensive for them to not have parts. I mentioned the mitigation of inflation with higher rent levels. So, and we sit on a portfolio that we own of 7.6 million square meters, excluding Germany. So after the German acquisition, it's actually 9.2 million square meters. That generates very stable, reliable, predictable cash flows. We have no tenant concentration. We have no particular regional concentration. What we have is we have a very granular portfolio that generates stable, predictable cash flows. And we reinvest those back into our development business. So we take the money from that business and we reinvest it back into growing that business. What we've done for the last 24 years, what we're going to continue to do. By expanding, we're better positioned to meet the demand from occupiers that we have seen and expect to continue to see. By expanding our footprint from the North Sea to the Black Sea, we're able to cover a huge swathe of Europe, gateway between East and West, and we have a land bank in and around our current parks that allows us to double our portfolio. Well capitalized, strong liquidity we talked about, and then finally this year we plan to deliver 1.5 million square meters of developments. Of that, 950,000 is already under construction. The rest will start in the next couple of months. Yield on cost, more than 10% for this year. And finally, we think that we will be able to increase our EPRA earnings per share to around 60 cents at the end of this year. So overall, we think we're in a great position. We're very happy with the first year that we had as a listed company. For you, maybe some of it was new. For us, it wasn't, because it was year 24. For us, we did it for 23 years beforehand. And we look forward to taking the journey together with you going forward. Thank you.
There's now a moment for Q&A. Can I take questions from the audience in the room first, please, and then I'll go to the internet, and then I'll go to the questions from the telephone conference. Anyone for questions for the board? Sander.
Good morning, team. Thanks very much for the presentation. Got 3 questions, please. First one is, obviously a lot of completions last year, very strong growth. Just a slight question on Q4 specifically, where it looks like EPRA earnings were 11 cents versus the quarter prior to that 13 cents. Just wondering what the decline was within that. Second question I had was on the current financing conditions. Obviously, you did really well timing, getting it to 1.2% average cost of debt. Now, obviously, there's a lot of uncertainty in the world. Like, if you were to refinance now, what kind of financing rates would you be looking at? And the last question was just more generally speaking, I mean, God forbid that something happens beyond Ukraine, but maybe even if that doesn't happen, I think fears of recession are obviously mounting very quickly. How are you thinking about that in your conversations with tenants? Are they thinking about not necessarily obviously shrinking, but just postponing decisions in terms of what they're looking to do with the requirements on the back of that?
Yeah.
First two, I do last one.
Okay. Yeah. Earnings per share, a little bit also, we had higher number of shares on average in the fourth quarter than we had in the prior quarters, also driven by the fact that we had 94% of our shareholders took their dividend as shares, not as cash. So no, nothing to worry about. If you think, is that a trend? No.
Millions they were down to.
Yeah, but only a little.
Why?
I don't think there's anything specific that you can look at there and say why a little bit. Yeah. No. If I would answer your second question in terms of our cost of funding, Sander, cost of funding now, I think bond markets would be really difficult for us. They reopened yesterday for 6 issuers, and I would expect, assuming the conflict doesn't escalate, that the bond market will continue to reopen slowly. If you look at who it reopened for yesterday, it was single A or triple B plus issuers, and we're triple B minus at the moment, so we would need to wait a little bit before the market opened. If we were to issue now, I think 5-year bonds would probably be 2% plus.
Yeah, maybe just back to your last question. In scenarios which we can't think of now, but suppose there is going to be a war all over, then I think that there's not going to be.
Or just a recession, really.
Yeah, or recession, which there is. Yeah, it's not going to be ever like always with a lot of tailwind. That is what it is, and that's not something which is new to us. Yeah, so that's part of life, and that's fine. That's absolutely fine. And at my introduction, I also mentioned that we have proven to be able to deal with that and turn it into benefits for the business going forward. And that is definitely also what we have in mind this time. So whatever happens, if there's going to be recession, if there's going to be whatever kind of situation, we are super alert, entrepreneurial, and we will react immediately to different circumstances. Sitting on €1 billion, which is also very nice and comfortable. Yes, there is opportunities in these circumstances to buy for cheap. It's not just a CTP share. Lots of things are for cheap now because of this uncertainty. So we'll adapt to that, yeah, as much as we are involved in this. Yeah.
Hi, Charles Boissier, UBS. I have 2 questions, please. The first one is, I think for some of your tenants, they make money in local currency, and they obviously pay the rent in euro. So I just was wondering, is there a level of change in the CE currencies? They've started coming down quite a bit, but so far it's contained. Is there a level where it's an issue for some of your tenants? I realize that for most of your tenants, they are international companies, so they probably do fine, but just thinking about that aspect. And then the second question is, you mentioned you're moving from fixed escalation. I think it was at IPO you guided 1.5 to 2% towards CPI link. So I just was wondering, what is the split currently? Thank you.
Yeah, in terms of the currency question, most of our tenants will have a local cost base in a local the local currency, so they actually benefit slightly from a devaluation of the local currency. A lot of their income will actually be in euros. So they will normally be moving their goods around from one place to another priced in euros. That's also why it's easier and better for them to have rent in euros. So it's rather the cost base that they have on the liability side. Some of them will have more of the income on the in local currency, but not so many. If I would answer the second question.
Indexation.
Indexation, yeah. So you're around 25% at the moment.
So 75% fixed and 25%.
Yeah. But the percentage increases on a regular basis because as we continue to grow the portfolio and renegotiate existing leases, they're all at the new level.
Okay. I have a question from Tim Hille from Kempen in respect of market, perhaps Remon. On the Ukrainian war, there are concerns that our relatively large Western European tenant base might be less inclined to expand operations in CEE, potentially hurting your business. Also, your automobile exposure could potentially be a threat. What is your view on this?
I don't see that yet, and I don't think I'm going to see that. The other way around. We have missed business opportunities from tenants who decided to move into the Ukraine with their production facilities, and I don't think we're going to see that soon again. So instead of them setting up shop in Ukraine, they'll probably rather go for, I don't know, Poland, Serbia, Czech Republic. No, and yeah, it's a strange moment here. But all those, but you will continue to drive cars and manufacture cars, and that will definitely continue. Same as the defense industry we spoke about. I think that is an industry which we will see grow in the coming years. And we have a number of tenants, for example, in Germany who are involved in this industry, and I can see them grow their business. As Scholz announced earlier that he said he's going to invest €100 billion in defense. So no, there will be opportunities. And
okay, let me just continue with some other questions from the internet. Karim Foat from Clarence Capital asked what the current pre-let is under the pipeline that we have. Perhaps Richard.
45% at the end of last year.
Yeah. Then from Jonathan Kaunater from Goldman Sachs. Can you provide a bit more color on the expansion and execution plans for Germany?
I can, yeah. So the portfolio we bought is 1.6 million square meter. There's properties throughout Germany, 600 tenants, and we currently work on growing occupancy to north of 90%. So it's a bit below 90. We want to grow that to 92%. There is still some vacancies, especially in different office areas, which are part of properties which are not But so we're not going to hit necessarily 95%, but I think 92% is in end of the year target for 2022. This is what, so the standing income producing is doing well, and we increase occupancy, therefore we increase also rent, which comes from the portfolio we bought. This is one. Second, is within the portfolio, there's land which we have identified a number of projects which adds up to a total of 170,000 square meter, 170, and those are properties which we like to develop over the coming 24 months. We are currently in different phase of design permit and so on. On top of that, we have bought land. We are buying land in Bremen. There is a future purchase agreement we're going to buy once the permit is issued. It's going to be Q2, and then we're going to start with that development, which is 30,000. So 170 plus 30 is 200,000 square meter of new stuff on the way. At the same time, so we have this income producing 1.6 million and the 200,000 square meter pipeline projects, which we are in different phases of construction, preparing construction. On top of that, we will continue to buy land. We are setting up an organization with 3 teams, Berlin, Düsseldorf and Frankfurt, local teams who will do development. So the traditional buy land, get buildings built for the tenants who we acquired with buying the DIR portfolio. In cities where we have assets because we bought DIR. So we go to the mayor and say, hey mayor, we have property in your city, the tenant wants to stay here, wants to grow, need more space, do you have land? And can we buy that to develop and so on. Plus then also there's good land for urban business park kind of opportunity, which is beyond the traditional warehouse and light manufacturing, but it's more for lab space or science technology park type of business, so more research R&D related. So at the other end of the manufacturing, so not so much low-cost manufacturing, but much more the R&D type of test facilities, where we see good demand, and that's what we want to do. We have done that in the Czech Republic, in Brno, the second largest city in the Czech Republic with the technical university. So from that we learned a lot of how to do this, and then we could potentially combine that with some young professional housing and create campuses for that type of business. So that is with respect to the DIR portfolio. So besides the income producing, it comes with a huge amount of opportunity. Very positive so far. We still need to get used to the German. But Barbara's helping me with that.
Okay.
Good so far.
Start to see the first signs of rental growth.
Yeah, obviously because under rented. So yeah, it's 37 euro per square meter. It's undermanaged, under rented. So there's a lot of work to be done there. But yeah, definitely. Yeah. And especially now, I mean, these people are paying 37 euro per square meter. I mean, there isn't just nothing for 37 euro per square meter. I mean, with all the construction cost increase, land price increase, inflation, all of that. So so we can only see increase there, which is possible because of short-term contracts and opportunities for rental growth. Correct.
I have one more question from ING, from Francesca. Do you see any further pressure on development costs compared to 2021? How are development costs progressing in the first months of 2022?
Yeah, it's a challenge, and it is, and it remains, and it, as I said, when we spoke about the 11.3% yield on cost, 11% yield on cost, that's quite an achievement, I think. It's going to be a challenge to keep it at that level. We always said around 10. We're working on that. What do you need to do? Value engineering, find alternative sources for where to buy building materials, continue to act as a general contractor. Scale. But that requires a lot of hard work. Yeah, and we will continue to do everything we can to keep it within that budget. On the other hand, of course, as Richard mentioned, we see rental growth. Yeah, so that's obviously. Yeah, and it's not that this is only for us. I mean, this is the entire market. So you just need to try and perform better than what your peers do. And I think if we sit on land, that helps because we bought land for historic prices previously. That helps. And the business model, which then requires more than 500 people. And I think if we look at the business plan, the ambition, we're going to double that over the next 5 years. So that is, it's a bit more labor you need, but then in return, you can be your in-house general contractor, which then therefore you pay less per square meter because you keep the 15% margin which the general contractor takes, you keep it in your pocket. And that is, on one hand, what you save. On the other hand, you have to invest a bit more in your own overhead, but that will remain under 10% of the total rental income. So yes, it is a focus and will be. But we're not concerned that we can't meet that target at this moment.
Are there any other questions from the audience? Because there aren't any from the internet. If not, that's the end of the presentation this morning. Thank you for your interest in CTP, and we look forward to working with you. Thank you.
Thank you.
Thank you, guys.